Guys and girls, welcome back to another BMO breakdown, and it is the 6th of August. Now, this week is a relatively quiet week on the front of it. As I mentioned, sort of on the back end of last week, the volatility all came in, or what we thought the data prints that would spark any volatility, we thought came in last week, which it basically did. But of course, the turmoil absolutely rolled over into this week. Now, we have had a bit of data come out. We had some ISM PMIs from service PMIs from the US. And then we've had some interest rate decisions from the RBA with a hawkish hold. And we're about to get, in about an hour's time, about 45 minutes, we're going to get balance of trade from Canada, which I think is going to come in very bad. And I think the Canadian dollar is also just on that weaker foot. And I think it's going to likely trade at that weaker, softer commodity block slash commodity currency risk savvy sort of a flow for the time being. Now, this week has so far, and I think will continue to be, largely irrelevant on this side. Now, why do I say that? There is a lot more going on globally and a lot more going on with regards to where money's flowing and why, irrespective of data. If anything, data is just updating us on the economy, and data is giving us an insight into what's going on in that region, and it may generate some slight reaction in price. But we are full risk off mode, in my opinion. And we're going to look at why that is the case when we get into the dollar. Now, like I said, balance of trade coming out later on today for Canada. And really speaking, it's this and this is my focus this week. Balance of trade from China and inflation from China. Do we see China pick back up again? Do we see a weaker dollar really play in the hands of China or not? Or do we see a stronger dollar emerge because of this risk sentiment moving forward? And in actual fact, off the back of that, it may basically kill off China and kill growth and kill business. Now, we do have some other prints, business confidence being all important for output in the economy, and of course, unemployment rate from Canada on Friday. But jumping into sort of the sort of lesser prints, if you like, we did indeed have a good character service from China. We did indeed have a very good service PMI from the UK, which of course, we know this is all important because they're a service-based provider. And same in the US, very good print from a PMI point of view. RBA held rates as discussed. The unemployment rate in Switzerland held at 2.3%, although it was forecasted to slightly drop. But we had a huge miss on retail sales. So definitely we start to see consumerism slow there. Retail sales miss month over month in Europe and then jumping down. I'm eyes on this tonight. I want to see how this comes out and how does the New Zealand dollar react. Like I said, all the sort of reactions in price in the minute are likely going to be short-lived. It's more so markets have more so been driven by the repositioning and the maneuvering of capital above all else. Balance of trade from China, like I said, and bringing back to the point of the maneuvering of the capital and repositioning, by the way, that's why I think this will be interesting to understand the health of the economy, but I don't think it's going to, U-turn price or cause any long-term trend in price. It's overall flow of money that's actually controlling that. Balance of trade from China, as discussed. Initial jobless on Thursday, keep an eye on that one. And then we finish the week basically with China and Canada. So yeah, it's a relatively quiet week on the calendar, but it's not a quiet week in markets. So I just stopped sharing my screen. It's not a quiet week in markets. And the reason it's not quiet it is pretty, let's just say, complex and interconnected, which we're going to explain to you in the US section. It comes down to yields. It comes down to fixed income. It comes down to global sort of outlook on recessionary fears and things like this. There's numerous indicators that are flagging to investors to be concerned, and investors have actually taken action on this, unwound carry, unwound optimistic-based positioning, and that's just led into panic. Basically, the most common and most practical and most favored holdings right now is cash, because everybody's like, I want to hold their cards close to their chest before they redeploy, which will explain a lot of the movements as well. But I'm going in circles here, especially if we break it down section by section. So unless you got anything to add, Mark?
I haven't, no.
So, guys and girls, let's talk how a fund is sort of approaching current markets, or how let's just say how an average portfolio manager or somebody with manual or discretionary oversight on a lot of money would basically handle this environment. Now, let's suppose, and this ties into the dollar, which is why I'm discussing it. Let's suppose you've been playing a portfolio positioning of somebody who is buy and carry. So you had a lot of Aussie exposure, Aussie JPY, New Zealand JPY, so on and so forth, dollar JPY. You were playing carry, you were playing equities, and you were playing basically the optimistic soft landing narrative, and you were basically simultaneously um, potentially holding some metals as a cross-market hedge, which has been the common theme. Okay. In an environment where the Nikkei prints the worst day it's had in history, Bitcoin's down by like a 10,000 a coin or whatever it may be. Nas is down 12%. Yields are down from short-ended yields in the US down from 525, 550 to low threes, 200 basis points down, give or take. What you're thinking as a portfolio manager, what you're thinking is, I need to liquidate all my holdings and anything that has exposure to volatility back into cash before I redeploy and before I store my capital into safe havens. So that's why when recessionary fears creep in, or when risk events kick off, what you can see is initially safe havens take a bit of a hit, more so gold and silver. And it's not from a point of view that they just devalue because they're not a safe haven. It's from a point of view where everybody's converting back into cash. And then the cash gets put back into the areas of value at a better rate. Now, why is this important to dollars? What you've seen over the last 2 days since the market opened, cable is actually trading below 127 now. Euro dollar's trading below 109 after peaking at 110. What does this mean? Well, it means that the market, in my opinion, is acquiring a bit of dollar at the minute. Why? Well, because it's the safer haven flow, but simultaneously, if you liquidate your stocks, your gold positions, your futures positions, your options, what are you settling that money back into? You're settling it into dollars. So before you reallocate, it's going to go out of dollars elsewhere when risk settles. It makes sense for the flow to be into dollars. And that's why the dollar is a safe haven currency. So that's why the dollar's been basically held firm. And then I want us all to understand that when recessionary fears kick in and when uncertainty increases, investors' first move is, or let's just say severe uncertainty kicks off. First thing that happens is go back to cash before we redeploy. Basically liquidate, cut positions. So that's what's happened in recent markets, and it's why we've seen so much turmoil. And really speaking, if you look at markets, it makes sense from a yields perspective. Yields have actually bottomed out 3.7, give or take, right? But yields are heavily down, right? Tens are down from 4.7, not even April now, but we'll go from highs of October down from 5% to 3.75, right? So we're about 120 basis points priced out. Twos have gone from 5.25 all the way down to 3.9. Okay. So we've priced out again 125 basis points. So we're not as bad, actually. So we're low threes, to be fair. I thought we were pushing low. Now, the point being here is, as these yields are bouncing back, the dollar's bouncing back slightly. Cable's down, of course, safe haven flows picking up, so on and so forth. But we saw a bit of a laggard effect. We saw a bit of a slow effect. Why are we not seeing silver up? Why are we not seeing gold up? It's because this allocation and this reshuffling of your portfolio takes time. You can't just do it all in one click of a button. Weightings have to occur. There's so many steps that has to go through to get the go-ahead to basically allocate there. And slowly we're starting to see the market move more risk off. Okay. Now, what happened since we last caught up? Obviously, NFP Friday. We discussed that with you on the call. Well, what we saw on market open was basically turmoil. For example, Nikkei hit the floor. Dow started piercing lower. We get rid of this. Let's go Nas. We saw a big sell-off in equity. Why? Because people are pulling money out of areas that they're worried about, they're scared about. So this article summarized everything very well with regards to the environment we're in, and it will summarize to basically why the dollar may basically trade a bit firmer for the time being. Now, stocks whipsawed in early trading with investors braced for more volatility in the aftermath of Monday's historic sell-off. US equity futures paired gains and European stocks sank into red. Treasuries retreated with the 10-year yield heading for the first increase in almost 2 weeks. Traders curbed bets that the Fed will step in to support markets with early interest rate cuts. So what happened is the market, which we'll get into here, if we go here, okay. I'll pull up the article now, but this is to do with the unwinding of the position. But there is an article that I have that basically explains the market very aggressively went to pricing in a 50 basis points cut in September. And then also the cuts just started increasing in pricing, and the market basically was deemed stretched. That's what caused a large portion of the liquidation, but traders have now curved back that thinking. Now, underscoring the broad market angst, investors are rushing to ensure their portfolios against extreme market crashes. In other words, they're liquidating against any volatility. And Street's fear gauge, the VIX index, remains at the highest level in almost 2 years. In fact, the VIX hit levels not seen in 4 years. Last time we traded here was 2020. Okay, so VIX was real long, real long. Now, Japan continued to be at the epicenter of the volatility. The TOPIX index surged 9.3% after plunging 12% on Monday. According to JP Morgan, the unwinding of the yen carry trade is only about 50% complete. We don't expect the lull in the coming days. The unraveling of the yen carry trade will continue to trigger margin calls and losses, while a sustained recovery in stocks hinges on central banks' measures and big tech earnings. I'm expecting the month of August to be red tainted. So that's another thing. We already know this. We discussed it last week, but earnings haven't been so good. Markets are very concerned. Markets are very anxious with regards to how are the sort of companies inside of these economies, how are they performing? Are they healthy? Are they not? And earnings didn't give the best mood off to the investors. Now, the violent moves over the last few sessions, in our view, present a buying opportunity. Jeffrey said, and basically JP Morgan agreed with them that, Goldman agreed with them that buying the S&P after a 5% drop is usually profitable. So they just said, basically, buy it and hold it and shell out. You'll be all right. Now, it is worth noting in commodities, oil held near a 7-month low as a halt in production at Libya's biggest field refocused attention to the Middle East. Gold steadied after being pulled into Monday's global rout when it slumped as some traders cut holdings to cover margin calls. So again, they were cross-market in their cross-market hedging their positions with gold, and they had to cut that exposure to free up the capital to, of course, cover that margin call. Now, if I just stop sharing my screen, I just want to pull up this article. It's very important that we understand as well, when it comes to the US, why exactly that sort of dollar may be holding relatively firm, okay? And why the market may be saying, actually, let's not keep punishing this dollar in this environment, okay? So if I just pull up MUFG's weekly, and we can go from there. So what they state in their weekly is the following. So the latest labor cash earnings from Japan, okay, not this one, it's the release of the ISM service for July and senior loan SLOs for Q2 after dropping sharply in 48 point June. Market participants will be watching closely to see if it rebounds in July, which it did. Another weak reading in July would reinforce expectations that US growth is likely to slow further, which it didn't. And I feel like because the PMIs are such a forward, leading indicator for market to understand growth and prospects, I think that also helps steady nerves slightly. That, imagine getting a huge miss in PMIs, for example, during all that turmoil. It helps steady the boat, okay? So it's just something that they were sort of looking at from a print point of view. What they do say, the key takeaways is dollar yen, dollar Swissy, and New Zealand dollar US dollar have had the strongest correlation in G10 with US rates over the past month. So if you're an individual, you're a trader that's expecting market to price in more cuts, expecting market to price out cuts, whatever it may be, this is likely sort of where you want to have your eyes on. And in contrast, dollar CAD and AU have had the weakest correlation to US rates. And I think that's because that has the most value, in my opinion, AU. Now, G10 have become G10 FX pairs become more strongly correlated with commodity prices over the last month. In other words, why has G10 FX pairs become more strongly correlated with commodity prices? Well, the more global growth fears kick in, the more oil sells off, the more gold picks up, the more the allocation will vary. Of course, commodity currency allocation is going to drop, safe haven allocation is going to increase, so on and so forth. The strongest correlation has been to the price of copper, of course, Australian dollar. The stronger G10 FX correlation to the price of copper could reflect the building concerns over slowing growth. There we go. Okay. So when it comes to the dollar as well, Citi had a take on the 50 basis points. They say, look, based off so this is the 2nd of August, this is on Friday, and they've said based off of that NFP print, they see a 50 basis points cut in the first reduction from the Fed. For some time, we had highlighted the risk of gradual weakening in the labor market, and it would and at some point would turn more rapid. This is much more evident in July employment data, with the unemployment rate rising to 4.3% alongside a more notable slowing in payroll and job growth. At 4.25% unrounded, the unemployment rate is just short of triggering the so-called SARM rule, but details of softer payroll job growth leave us expecting even further slowing in the coming months, with SARM rule very likely to trigger. We now expect Fed to start the cutting cycle 50 bips in September and November, followed by 25 basis points cuts at each meeting. So if we go to the pricing of the CMEs, this is why that dollar basically had the volatility that it had. But simultaneously, the reason it's holding so firmly right now is because that sort of VIX spike uncertainties held that dollar steady, held it sideways, if not arguably made it slightly bid in the immediate term. Why? Well, because of course everybody's going back into cash, back into dollars to then reallocate. Now, as you can see, we're currently at 5.525 to 500 is our current interest rate in the US. Market's priced in a 50 bip reduction. We're 75% sure of that for September. Market then sees another 50 basis points cut. Of course, 50% probable of that in November. And December, then it's a toss-up between, do we see an additional 25 basis points in the market? May, subject to how the environment goes, could start to even move to another 50 basis points. So if the market priced in 150 bips of easing by year end, I think that's very aggressive and overly priced. And it would leave, in my opinion, an opportunity to potentially be long dollar as that narrative unwinds so long as data holds relatively firm. I think the market can get ahead of itself at times and just be cautious of that. But apart from that, Mark, the only thing I'd like to add is a key trigger was certainly the weaker than expected non-farm payrolls last Friday, resulting in both a big reset in the Fed rate cut expectations, coupled with recessionary fears. Nonetheless, the bigger underlying theme of the market of carry trade unwind was already happening for some time since July, and certainly accelerated the Japanese yen strength sharply against the dollar. Popular carry trades, long MXN JPY and short CNH INR, have likely been closed while investors were borrowing cheap and taking on more risk and buying the Nasdaq, so on and so forth. So they were levying up their trade with the carry, right? Now, from an FX perspective, while the dollar was weaker in aggregate, it's important to note that this cycle looks meaningfully different to the recent dollar weakness cycles in in Q4 of 22 and fourth quarter of 23. For one, there's been significant disposition in performance with JPY a clear outperformer and a high beta to carry currencies. Second, and this is very important, the dollar has been weakening even as risk sentiment weakened sharply and equity volatility spiked as recession fears looked to hold, a dynamic which is somewhat unusual. That is where I said to, and I was reading this and I said to Mark before the breakdown today, I said, I think that statement's sort of been proven today more than anything, and yesterday sort of untrue now. Why? Because we're actually starting to see, as equities are down, as gold's moving sideways and whatnot, cable's heavily down, and we're actually breaking very key levels now. So let's see how basically the dollar holds at these, very key levels. Let's see if we get a reversion on this dollar. But for the minute, actually, that's incorrect, the statement from MUFG, because the dollar is actually stabling out in this uncertainty. Now, this is a very important thing to read as well. They said, so where from here? Our best sense is that price action somewhat seems exaggerated from a fundamental perspective and should be partially viewed as position adjusting. In other words, again, portfolio repositioning. Also deleveraging by investors who borrowed cheap money excessively. Yesterday's stronger than expected ISM is a case point and indicative of the US economy, which is slowing, but not collapsing. So that's what I mean, it's steady the boat. While we do not think the market trend should be linearly extrapolated from here, this is not to say that the deleveraging dynamics will not continue. Certainly the massive market moves seen are also suggestive of more leverage in the system than we thought. So basically, prepare yourself for more volatility. So that's really all I have on the dollar, Mark. It's basically just summarizing what's happened since we last caught up, why that's occurred. Because this week, we basically have a blackout on data. We've already had the US side of things with data. I think it's the biggest driver of dollar right now is uncertainty, unwinding, and yields, of course, based off the back of CMEs.
Yeah, I mean, obviously a lot of things has happened very quickly. So don't be surprised if we do see a little bit of a pullback in the dollar, i.e. upwards, before maybe eventually going a bit lower again. People aren't really focused on politics at the moment. As you probably know already, nobody's, again, I believe I saw over a couple of days just some news on politics, but that didn't really move the market, right? So it's more so what the data is saying and kind of what does that mean going forward. So yeah, let's start off with this one over here. Goldman, just see what they say. Again, what you got to remember is everything's happened very, very, very quickly and very, very aggressively. So like I mentioned, don't be surprised if you do see a little bit of dollar strength before maybe we eventually go back lower again. We are obviously seeing people start to talk about 50 basis points. I mean, it's entirely possible. What we'd need to essentially see is more downside in some of the key data sets. The only, one thing that has kind of countered that view is yesterday's PMI data, which actually was not terrible. Employment actually went into expansion territory for the month of July. So yeah, I mean, it's definitely up there in terms of the calls, and we're not going to deny it because it is entirely possible. It depends on the data, right? So let's just see. Now, our economists think the July employment report likely overstates the rate at which the labor market is loosening, but the report certainly validates the FOMC's elevated emphasis on risks to both sides of the dual mandate. They now expect the FOMC to begin the cutting cycle with a string of 25 basis point adjustments, with a clear risk to a 50 basis point cut in September if the next employment report confirms a slowdown in job growth. So like another rise in unemployment rate and another weak NFP would be that sort of catalyst for a 50 basis points. The state level data in 2 weeks should also help discern whether the sharp rise in temporary layoffs are a reason to be more optimistic. The market is now pricing an even more aggressive start to the cutting cycle, and the FX market reaction was consistent with the likely policy response outweighing the growth news. Despite these caveats, there are clearly still risks to dollar longs. Not only do we think the bar to justify market pricing is low, but markets will also likely react to strong data misses than makes over the coming weeks. Again, like even if it makes the data, or what like this there in quotations, or beats the data, like it's better than consensus basically, that's not gonna do too much, right? You know, people are essentially expecting rate cuts now from the Fed. Like a little bit of a stronger data is not generally going to move it by that much. You'll see a little bit of reaction, obviously, but it's not going to sort of change the market's view, right? So that's obviously one thing. They're saying there's more risk to downside than upside in the dollar, essentially, at this point. Rising recession risks are still dollar negative for the most part when real rates have room to adjust, especially when the shock emanates from the US. Safe havens like JPY and to a lesser degree the Swissy are clear winners, and we attribute the bulk of the move in these currencies over the last couple of weeks given to this factor. Further afield, it can also push crosses like NOK/SEK lower, given the interplay between growth fears and coming policy support. So haven't really looked at NOK, but let me have a little look at that now. So USD NOK actually not moved by that much. So yeah, I mean, it does go to show you what they're saying there is probably correct. NOK/SEK, GNOK, GBP NOK. Yeah, I mean, what was it? Monday, Tuesday, Friday, Thursday. Yeah, I mean, it's really not moved by that much, especially when you compare it against like the riskier currencies like GNOK. Like GNOK's really not moved by that much. So let me just go back there. Crosses such as NOK/SEK lower, given the interplay between growth fears and coming policy support. So that did actually move lower. The US is hardly alone with the slowing growth and clear evidence that rates are in restrictive territory, which is why the rate-sensitive crosses like Japanese yen and SEK are both relative winners, even though they normally occupy opposite ends of the risk spectrum. That said, we think the Fed and the Bank of Canada will have plenty of company in the shift to consider growth risks more prominently. In particular, while Euro area GDP is surprised to the upside this week, survey data suggests that the high point for the disinflation dividend and momentum have hardly slowed in Q3. FX is still a relative game, and we still think the US will present a high bar to beat, especially within our framework that it will be hard for the dollar to depreciate significantly with election risks on the horizon. We think markets have moved too far relative to these fundamentals, and they obviously recommended people go short euro dollar, but that obviously went through to their stop loss because we hit 110 yesterday. So yeah, I mean, it's kind of logical why they wanted the short euro dollar. Like I was like, okay, that does make sense because it's a bit overstated in terms of like the big move there. But there just wasn't no technical entry for us to get in anyway, so I probably would have entered. So yeah, I do agree that it's probably a little bit overstated, at least like a 50% pullback. And by that time, we should actually have a bit more data to go over, hopefully by then. So if I just quickly show you my screen very quickly, and if we just have a little look as to what US data we have that might move the needle, it may or may not. Obviously, it just depends on what data. But ISM services yesterday, again, like that didn't actually go into negative territory as we were previously, which essentially means for that month it's expanded or contracted. And it's basically battled the idea of what the unemployment rate said, especially if you look at the employment PMI for July, which was obviously 51.1, previously 46.1. So we are seeing from contracting to then back to growing territory. So that kind of battled the view of what we saw. And then obviously today, well, nothing's really happened so far today. So yeah, dollar is pulling back ever so slightly now, as you can see, but that'll likely be, well, at least 50%, right? So if we go 50% of this move here, we're actually nearly at 50% now. So we'll just have to see how do we react. It looks like the speed in which it's moving up probably suggests it can go a bit higher. What I'd say is more 48.71 than at that point. So basically towards this next low down here, which is about there. So that will probably be where the next move on the dollar goes. And then obviously on Thursday, we have unemployment claims. This will probably be a lot more focus now, given what we saw last Friday. Because again, if people are worried about recession risks, a rise in unemployment claims will definitely reiterate that recession risk. So if this pushes towards 250 or above, then people are going to start to worry again, and et cetera, et cetera. But Goldman actually made a really good point. If I just quickly read that sentence again, as to, well, you might be wondering, why is the dollar not rallied really aggressively on Friday when there's that clear recession risk? Which is, if I just quickly find it for us, they're saying rising recession risks at the moment are still dollar negative for the most part when real rates have room to adjust, especially when the shock emanates from the US. So what they're saying there is when real rates are higher, which I might have the ticker on here. It is some really weird ticker. It's this one here. But real rates are, well, positive at the moment. What they're saying there is it still has rooms to adjust. So again, I'm going to have to go on the line. It's probably a bit easier. But you can see it's essentially higher still. So if it has room to adjust, which it technically does, you can see if we just go back in history, it generally stays, well, 0% is here. It still has lots of room, right, to adjust either side of the curve. Obviously, depends on what inflation does, what rates do. Obviously, if rates are expected to be cut, then again, it will have to see what inflation does. But real rates prices inflation in. So if it has room to adjust, especially even if you look at it from like a normal bond market perspective, we still have all of this to adjust. Even if we move like a 50% move of that, like that's still a lot of downside on the 2-year yield. And it's saying if it emanates, i.e. the issues are US specific, then that tends to be USD negative rather than dollar positive. If it's like a global issue, like we're starting to see recession risks in the UK and Europe and Australia and New Zealand, basically everywhere else apart from the US, then that tends to be dollar positive. So that's just one thing to know. That's actually a pretty good adjustment there, or thought process. Just something for you to sort of consider. Now, ING actually expects that the dollar rebound, i.e. the pullback that we're seeing at the moment, to be fairly short-lived. So let's have a little look. The key takeaway at this stage is that the dollar has lost its safe haven appeal. That is because US soft data was behind the market turmoil. So that, again, ING is also saying it's US specific data rather than everybody else, right? Everybody else isn't really seeing these big rises in unemployment, apart from like Canada. But apart from like everybody else, Europe and UK and Australia and everybody else essentially on sort of the eastern side of the world, if you look at it from the US, eastern being like Europe and the UK and Australia, they're not seeing those big recession risks. So it's more focused on US, which is dollar negative and highly favors the other safe havens like Swissy and the JPY. The bet here was that Powell would react not just particularly to the worst macro picture, but the greater extent to an equity sell-off instead. So if we, again, just look at equities, like that's a pretty large move to the downside. And from the high, we're at 8%. So there's still a decent amount of adjustment there that could actually happen. So if we come down to this low, it's a 12% move. We come down to the previous high, it's a 14%. Technically, it has all the way up to 20%. 20% is the technical term of a recession, or a sort of a bear market trend, if you will. Like when we saw during COVID, that was obviously a big recession concern. Obviously, we came into like 30 something percent. Yeah, 34%. So it still technically has a lot of room to adjust there. So that's what I'm saying is Powell may react a bit more to the equity sell-off. Because again, big sell-off in equities hurts a lot of people. You got to remember, it's not just big investors that are going to feel the pain. It's also people who invest into pension funds. Because if they see a larger sell-off, then they technically feel they feel less rich, if you will, because they have less money in their 401ks, which is the US version of an ISA, which is the UK version. Now, after all, Goolsby, which is a dovish-leaning FMC member, said the Fed won't overreact to one soft jobs data, and the ISM rebounded above 50, and there are explicit concerns about inflation trajectory at the Fed. Now, we are not equity strategists, but risk assets are looking at the potential risk of a Fed under-delivering in terms of dovish communication. We also have the US CPI report next week, and any upside surprise can definitely ignite a more risk off, as hopes of larger cuts have to be scaled back. In that scenario, the dollar would regain its safe haven appeal, but for now, the greenback will retain a positive correlation to equities due to the Fed easing implication. The US calendar is obviously empty today, but early signs of shocks rebounding means some upside risks for the greenback, in particular against JPY and the Swissy, as the Fed easing is scaled back, essentially people overstating the amount of rate cuts that can actually happen. Still, once stock markets ultimately stabilize and barring any inflation surprise next week, the dollar should head lower in our view. The repricing lower in the Fed terminal rate now means the dollar's rate advantages have been trimmed, and there is still room for pro-cyclical currencies to readjust higher versus the dollar on the back of more favorable rate differentials. For example, like AU. Like AU actually had a large sell-off, and we essentially pushed into the bottom end of this range down here. But that doesn't really suggest where we should be at, right? We're just bouncing on the higher time frame ranges, as you can see. Since 2023, literally, we've just been bouncing up and down, up and down, up and down. So once the Fed and markets jump back on board dollar bears, this should actually start to break the highs as we sort of reprice that further out. So yeah, apart from that, that's all I wanted to cover. I will look at all of this stuff later. This is more like JPY specific. But there is definitely worrying signs on the US. We are just having that pullback now. So yeah, as long as we can get that further nice pullback, we definitely should start to sort of scale that back in. Because again, if the data starts turning, if the market is actually trending in terms of the data, if the data is actually trending, it will start to trend, right? It's not like a market where it just goes up and down, up and down, up and down, up and down, up and down. If it starts its trend and it is in its trend, then it does tend to trend in terms of its data. So if the markets are right, or if they are right in their reaction in terms of the rise in unemployment rate is now going to start to trend, then, or the layoffs are starting to trend, or the labor market is now starting to trend in the more weaker side, then you would want to state a more weaker dollar going forward at that point. And then all you do is you go on the high time frame, and then look to your next low, which is probably going to be about, have we wicked into that low? Doesn't seem like we have. So around these lows down here, or at least down into the bottom end of this low again, if not all the way down into around 100, or maybe just into this low here, which is about 101, is where I would personally go for, as long as the the political risk is sort of not there at the moment. But as we know, it obviously depends on timing, right? How long does it take to get there relative to when is the election? That's essentially how you think. So if we get here and we're in September, October, then markets are unlikely to push towards 101 or 100 on the DXY, because now there's still a very high likelihood of recession, political risks, and markets may go long dollars. Obviously depends on Trump, etc. And then it will go back up again, and then from there we'd have to wait and see. But yeah, apart from that is myself and the dollar. Let's have a little look. So dollar CAD, we pushed 139. It was our target anyway. Can we push above that? I'm not going to, personally, I would more say it's going to stay in consolidation now. We should just stay relatively consolidatory, if that's even a word, until we see sort of a breakout, either, let's say, I don't know, really, really dovish Bank of Canada might be that catalyst to breakout, or markets readjusting their thought process in terms of rate cuts and thinking, actually, based on the totality of the data we've actually just saw now, 50 basis points is unlikely for September. If that's the case, i.e. what would happen in that front is the data in the US would actually go positive, or at least not point recessionary. And then we'd see a push above, and then 140 would be on the cards at that point. So it really depends on, this move higher is more likely to be markets readjusting their thought process rather than Bank of Canada. to be honest with you. Yeah, at least in my opinion. Dollar Swissy. So dollar Swissy, we've broken below this low, broken below this low. Where's the next low? The next low would be about 83,500, give or take, which is roughly here. Can we push there? I mean, I can't see no reason why not, especially if the US data continues to point lower, but we are due some sort of pullback now. We can all agree that this is very, very stretched to the downside. You generally do not want to be trading in that environment. You want to see at least a pullback, whether it's 50% pullback, which is generally a pretty good pullback, at least. Like we're nowhere near 50 yet. That's more like 38.2. Obviously, a lot of us do not trade 38.2 pullbacks. So at least a 50% is what I'm aiming for. Does that line up with any lows? Not really. We are reactive from this low, but from my own personal technicals, that's not really an environment I would look to sell off in, just because we haven't pulled back at least 50%. So yeah, I want to see at least a 50% before I get back in again. Dollar yen as well. Like this is pretty stretched to the downside. So even if we go from this low here, right, we're still not pulled back 50%. A 50% would be about to the low we made around Thursday before obviously Friday's data. So if we can get a pullback into that, that would be very nice to see. That would literally be because people are rethinking the idea of the amount of rate cuts from the Fed. So if that's the case, absolutely in that environment, the markets would go back long. All you got to think about is, why did the dollar sell off so much? Well, it sold off all throughout this period because people were obviously, number one, pricing in a lot of rate cuts from the Fed. That was actually the primary reason. So people now start to rethink and say, actually, we don't think that many rate cuts is going to happen now because of data or because of Fed speak or whatever is the catalyst. You'd have to watch the reaction of the dollar at that point. Then you think, okay, that large move we saw there is probably going to get pulled back slightly. And because of the whole reason it sold off was because of rates. Now, if rates are readjusting back to where we were prior to this big sell-off, then obviously we're going to see a bigger strength, a bigger push in the dollar. So that's all you essentially think is, what was the reason it sold off? And if markets are overstating that, look at it from this perspective. If you go back to pre-2024, markets sold off the dollar so much because of the amount of rate cuts. At this point, it was about 150 basis points from the high. So as we got towards the low, it was 150 basis points worth of rate cuts. People rethought that process because the US data got better again. If we see the same thing here, where people expect so many rate cuts, if data gets better again, you're going to see a big old pullback in the dollar. So just think about it like what we saw when we came into 2024. Apart from that, Drew, that is myself and the dollar. Was there any technicals you want to look at before we summarize?
No, not from a dollar point of view, Mark. I think it's one of those where I think it's more XXX dollar. But from a sort of direct dollar perspective, there's nothing that I'm really eyes on. I mean, dollar CAD bounced 138, dollar yen's bottoming at 142 now, and then dollar Swiss is bottomed out about 184.5. But yeah, there's nothing really on the table for me with regards to the sort of dollar crosses to trade. So yeah, to summarize with the dollar, I would say we are in a market where Mark made a very good point that it's very hard for any optimism to come from data with regards to the US. Although it may somewhat materialize into less cuts expectations, but I doubt it. At the minute, the key drivers for the dollar is simply how many interest rate cuts are expected from the Fed, which is trackable via CMEs. And also, of course, the risk sentiment, the unwinding of the carry trade, the surge in the yen strength, the miss in the tech stocks, the amount of leverage in the market is crazy, right? But the points I'm making, there's numerous risk factors out there at the minute, which would not surprise me to see the dollar remain range bound and sideways. If things get severely bad, we may see basically the flow come back into the dollar because it's a safe haven cash settlement, basically. So yeah, the inflows of the dollar are likely ticking more so on the up than down at the minute, and that naturally will just increase the demand for the dollar. So that's the only thing that I summarize with. But I would also say this week's very quiet on the data front, so just keep in, let's just say, tempo with yields. So if you're in the tempo with yields, what I mean by that is you understand where the levels are on your yields, you have your alerts, the tempo of which they're moving in, how aggressive they're pricing in, pricing out rates, so on and so forth. If you're up to date with your yields, you're watching your equities, I think you'll understand the fact that the dollar should remain sideways, if not arguably slightly bid, just because there's so much already in price. But let's see. My summary on the dollar on a whole is that I'm relatively neutral with a understanding that it's likely going to softly tread over the next couple of weeks. I think be very cautious. There's a lot already in the price of the dollar. and other G10 central banks will be cutting, will be experiencing downside growth prints, so on and so forth. So just let that brew at the back of your head.
Cool. Yeah, I mean, it's pretty much the same, right? Just think about early or late 23, early 24. People were extremely bearish the dollar at that point because of, well, rates were suggesting they were going to cut by like 150 basis points that entire year, right? And then all the market saw was, oh, data's suddenly got better. Well, there's no need to be this bearish in the dollar if it's from a rates perspective. It's exactly the same shoes that we're in at the moment, where the data obviously went worse or went bad on Friday. Obviously, we can all agree that's a pretty bad print. The reaction of the dollar was absolutely understandable. But the question you have to ask yourself is, does the market, as the market overstated, that the Fed is going to cut by how many's expected from now until the end of this year? I believe it's 50 in September, and it's bubbling between 50 and 25 for November, and then December is still 25. So let's just round it to 100 basis points worth of rate cuts since now until the end of the year. Does that seem like a lot? Yes. Do you think the markets have overstated that? Probably. So you're more likely to see a repricing at this point, at least in the near term, until the election point. So that might mean actually a little bit of a stronger dollar in the shorter term. Think of it like a pullback. And then as the markets get into your zone, think, has the data gone negative again for the dollar? Then yes, you'd go back bearish it. If it hasn't, then you'd think that actually that zone is probably going to get broken. Where's the next zone above that? Or if you're sort of looking to buy dollar, where's the next zone below that for like euro dollar, for example? So just think about that. So that is us on the dollar. Let's move straight on to the pound. So the pound. Now this week, literally nothing in terms of the calendar. We have more volatility come from next week. If I just quickly show my screen. So this week, the pound is more likely to follow. Does the market go back to pulling the dollar back higher and being less pessimistic? And if that's the case, then, or let's put it this way. The reason that the pound has sold off aggressively, obviously since Friday, is because of the fears of, oh, maybe there is going to be a big recession. And obviously the markets went massively risk off, equity sold off, and the pound tends to do fairly well in an environment where equities are much higher. So that's the main reason is the pound is literally going to follow what risk sentiment is going to do up until next week. As you can see here, we have the policy report hearings, might see a bit of movement there. Claim account changes, average earnings, unemployment rate, CPI, GDP. So next week is going to be a pretty busy week for the pound. But for now, how you view it is well, if you look at here, nothing's really happening this week. So the pound is only going to essentially follow what risk sentiment. Does it get worse this week or does it get better? If it gets better, you might see a little bit of recovery in the pound. If it gets worse, markets will go back bearish the pound, at least in the shorter term, because of risk sentiment, not because of UK is now suddenly really, really bad. Nothing's really happened in terms of UK specific data last week that would have suggested that. So you think it's more external factors rather than internal. So I've only got actually one thing to mention. And Goldman's basically in the same shoes where it's just literally risk sentiment that's going to be the driver of the pound, at least over the near term. So let's have a little look. Beta over bank gets harder. So we have long argued that sterling should benefit from a solid risk sentiment supported by lower yields. Even if the Bank of England keeps real rates relatively low, that's still in our view. But this week's BOE decision highlights the tension. While it was a narrow decision, the BOE emphasized the uncertainty, with some of the 5 who voted for a rate cut acknowledging it was finely balanced. It is still important that the MPC decided to cut despite stronger growth, firmer inflation, and the possibility of further inflation pressure from recent government pay proposals. Taken into isolation, that is the type of policy reaction function that weighs on a currency. However, we expect the BOE's calculation that while rates clearly is in restricted territory, it is better to be early than late while become more of the norm in coming months. So it will not be a dovish outlier for long. We therefore think the trend in Euro GBP is still lower, but with the recent disruption is understandable when viewed through the lens in the context of turbulent risk markets that has not been supportive for the beta either. So they are, again, what they're saying is the pound should actually be higher. It's literally just risk sentiment that's driving where it's going at the moment, which is obviously true. There's no real reason for the sort of big move low as we've seen in the pound recently anyway. So if I quickly show you my screen in terms of what's moved and what hasn't moved, and let's have a little look. So yeah, this one over here. Now we look at GA. Again, GA obviously spiked, and that was more because of, again, markets just going really back. Well, they were sort of following through that worrisome moves, if you will, on the dollar. Obviously, the dollar did sell off yesterday, as we saw, and then obviously GA pumped. As naturally, people are just scared of risk, essentially. So if Aussie dollar being very, very sensitive to risk, more than the pound, actually. Obviously, the AED will weaken off a lot more relative to the pound. But you can see it kind of done that, wicked, and then just kind of came back to pre-Monday price action. GCAD as well. That's actually surprising me, a big move to the downside there. But nevertheless, I'd see it more as stretched positioning. People are worried, so they're just going to pull back the pound. We're about 50% now, but I'd monitor more so this 75 level, and then we can monitor. So I'd like to see some stabilization at around 75, and then breaks above the highs, and then we can get back into GCAD longs. Depends on obviously risk sentiment, right? Pound Swissy. Again, obviously, this is completely understandable. The reason why the big sell-off happened, you got a risk-sensitive currency like the pound that doesn't do too well when equities are pushing. So if stock market's pushing lower, basically, then massively lower. It's not like it's just a little bit of a move. It's pretty selling off. Pound is not really going to do too well in that environment. And especially if you couple that with recession fears coming back into play, well, Swissy obviously downside makes a lot of sense. Probably can continue, at least in the near term. So what I'd do is just look to my left and say, okay, where is the next low on pound Swissy? It's likely to be this low down here, which we're not too far from now. So this would likely be where the next low for pound Swissy. And then we can hopefully stabilize there. And obviously depends on the US data at that point. Like I mentioned earlier in the dollar section, pound today is going to be pretty quick, by the way. But like markets might view unemployment claims again as quite an indicator. Because if unemployment claims are rising, then the unemployment rate might rise also, or at least you might start to see layoffs and sort of weaker employment prints from there. And then people will start to sort of go back sort of massively bearish the dollar at that point. So we'll just have to see from that perspective. And obviously that would be more bearish for pound Swissy. GJ as well. Obviously, this is coupled with really hawkish BOJ, obviously coupled with Friday's risk off tone that we saw. You are obviously going to see yen strengthen a lot in that environment. Can it go lower? Yeah, I mean, I would say it would go lower. I just want to see a deeper pullback before eventually getting back in again. Again, like it's just one of them ones. I don't really want to be selling all the way at the lows. I want at least a 50% pullback before I even consider going back. And as well, this is essentially just followed GA, if you will. This is obviously Monday's follow through. So again, we saw that big old sort of bout of dollar weakness again. People are essentially just following through the sort of weakness, if you will. But what we see now is it will hopefully come back into this higher here, or these previous highs. So if we can get a pullback into there, a stabilization, then hopefully we can get back long again. I'm just not going to go long at this given stage, especially if sort of risk sentiment is still very, very fragile, if you will. You want to see at least a stabilization from risk sentiment. And how do you get that? It will be essentially the data stabilizing, or at least pointing against what the unemployment rate stated on Friday. So we'd see like the unemployment claims come in lower. We'd see the, we have major US, we do have CPI next week. We'd see essentially data battling the view of what unemployment rate said. So that would be like retail sales getting a little bit better. The Thursday, unemployment claims getting a little bit better again. This will be data that's starting to sort of battle the idea. So people would view then as the rise in unemployment rate as like a one-off. And if that's the case, risk sentiment would go slightly better. Obviously, equities would go back to be in sort of bullish again, because at that point, people are no longer worried about risk sentiment. And obviously, GN should hopefully go back up again on that view. Now, GU, again, this is literally just following risk sentiment, people readjusting. Are we coming into any high time frame zone? That is my thought process here. Starting to, we have this 12-hour down here. Hopefully we can get into that. That's quite an extreme pullback from that higher. Is there any 8 hours? 4, 6. Yeah, so it looks like it's more so that 12-ish hour region, if you will. Anyway, within there, I'd actually just extend it into 88, just so I can get into sort of this zone, if you will. But anywhere within there as well, I would actually look for some sort of stabilization, some sort of starting to reject, some breakouts, and then we can start to get in on those pullback opportunities. It doesn't have to break out the zone. Some people might be thinking that where, oh, it needs to break out the zone. Not really, as long as it breaks the structure. It could be in the zone, it could be out the zone, it doesn't really matter as long as it breaks the structure. So the 1 hour structure at the moment is still very bearish. There's been no breaks above the lower highs. So you're not even considering going long GU anyway at this point. So we're still very bearish lower time frame. Let's just see if we can start to break out on the lower time frame at this point here, at least within that zone. And then apart from that, that is myself on the pound, Drew. Was there anything you wanted to consider? It's fairly quiet anyway, so I wouldn't be surprised if you haven't got anything.
Yeah, I've got one sort of snippet from MUFG. They basically, as they do when they summarize documents, they go through their sort of rates outlook, they go through their sort of valuations, so on and so forth. And they've basically reaffirmed what you've said, Mark, with regards to there's numerous risk events and uncertainties bleeding on the optimism of the pound. And that's what's basically causing that devaluation. They say the long pound positions held by the leveraged funds prior to the recent correction lower for global equity markets has reached their highest level since April 2018. So that's why the pound was also vulnerable in the near term for even more unwinding of those pound positions, by the way. A number of fundamental factors are currently challenging global investor risk sentiment, including softer economic data. So optimism over soft landing is not as heavy. Rising geopolitical tension in the Middle East, so on and so forth. They break over the rate cut, which we already did last week. But what they say is the initial gradual pace of BOE cuts is unlikely to trigger a bigger pound sell-off on its own unless backed up by deeper correction for risk assets. So basically, the pound in the immediate term is likely more so trading on a risk front than it is on a BOE pricing front. Now, when it comes to the pound, obviously we saw a huge spike in GA, huge spike. And this is why I was saying, guys and girls, I want to see that 195 break. And the fact it didn't break just goes to show with the fact that we have buyers basically still present. And those buyers showed us that they were there and they ramped all that way up to of course, basically the 2 mark, which is what I would now argue is probably the high of this, but I'm not calling a high on this after all the headache. But look at it, just look at that for a wick. Now, I'm not getting involved in this until I see 195 break. Pound CAD is showing signs of downside. We've seen that break of 176, which is an all-important handle now. So if you are looking for pullbacks on this, be my guest. But I would personally be sort of trading this with hedging in mind. That 174.5 looking pretty clean. Pound Swissy, we did bounce the 107.5, but this is peeled off crazy. I really like the upside of this at like 113. But of course, as we know, sentiment and how things have developed, it's no longer, a screaming buy because of rate differentials and whatnot. If anything, it's more susceptible to that sentiment, and that's reflective in price, as is pound yen. So yeah, that's why I'm just completely hands off both of those two. Not really looking to trade, but GU, we are now trading into that monthly demand. So that monthly area of demand that we're still in it right now. We did get, to begin with, a good reaction off the level, but 128 has been where we've sold off from. So at least we now know where, of course, sellers are. Now, we can actually refine this. 8, 12, perfect. So this is where I'd be more concerned if I'm buying GU about, will I hit problems? Will I hit a headache? This would be where I'm watching in here. Now, if I'm buying this or if I'm looking to long it, 126.5 looks interesting. And if we break these orders at 126, I think it's basically a free fall to 125.5. Not financial advice, it's just what I'm looking at within price. FTSE also experiencing a heavy downside day. Equities on a whole, global equities are taking a huge hit. And irrespective of it being in a weekly area of demand, yes, you're getting good value. But if sentiment keeps deteriorating, don't be surprised to see it push down to other areas of higher time frame demand. Okay. So yeah, really speaking, Mark, the only thing that appetizes me with the pound is simply GU from a 126 to 128 perspective. And GA, if we break that 195 handle, I'll start to weigh up price and keep a very close eye on it. But yeah, apart from that, that's me on the pound.
Oh yeah, to summarize, if you remove risk sentiment out the equation, then obviously pound would be much higher, right? But it's just that that risk sentiment is obviously weighing on it. So all you basically follow is if risk sentiment gets slightly better, again, the markets will go back long the pound. It seems like it's the most logical explanation for the price action we've been seeing recently. Is it's purely risk focus rather than fundamental data focus. So how do you follow it is if you see, for example, US data getting better again, and then markets think actually maybe risk sentiment is going to get better again, the markets will go back long pound and you would see equities rise again. You might actually see even the dollar rise and equities rise at the same time, which some people, you always got to think context, right? Why is equities rising? Why is it falling? Why is the dollar rising? Why is it falling? In this scenario, you might actually see dollar rise and equities rise. Dollar rising because of, let's say, markets repricing, equities rising because data is getting better and it's no longer recessionary. And the pound may also rise with that. So especially if equities continue to push higher. At the moment, obviously, equities are lower because it's still fresh, right? We've not seen like a change in that sentiment just yet. So at least over the near term, then the pound will be more pressure to the downside unless we see a switch back to positive risk environment, which would be data in the US getting better. So we're only going to have a better clue of that on Thursday's unemployment claims. Like I mentioned, that might be better to sort of wait for the pound at that point. And then hopefully you might see a bit of reaction. If not, it'd be more so US's data next week. That would be the driver of that risk sentiment again. But yeah, I'd say just follow risk environment for the pound at the moment. And yourself, Drew?
Yeah, I think, look, when it comes to the pound, the pricing element is not a factor at the minute. We're pretty comfortable we've had a cut and the next one's in November at the current pricing and the current data that we know. It's solely sentiment. We're either optimistic on global growth and output and economic health and softer landings and easier times, or we get fearful, which, you could argue the pound's almost trading in the highest sort of the similar beta to commodity currencies. So I think, as Mark said, sentiment will be the immediate driver of the pound until told otherwise, basically.
Cool. So that is us on the pound. Let's move straight on to the euro. So the euro. Now today, we only had a little bit of retail sales this morning at 10. Came in a little bit on the weaker side relative to the consensus anyway. The forecast was 0.0%, so flat. We came in at negative 0.3% on a month-over-month perspective. Obviously, that just generally doesn't look too well. And in terms of like euro reaction, a bit of a mixed bag, I'd say, across the board. What you got to remember is the data that comes out, the markets will only tend to move if it generally changes the idea of something, or at least like battles that idea. For example, like a good example is, let's say, inflation. Like if inflation comes in lower, would that mean that the Fed is going to, or whatever central bank, does that mean they're going to cut by more or cut by less? Obviously, cut by more, potential that be more dovish, cut a bit more, markets price in that, and that's what moves the market. Retail sales is important. It's just generally won't change then an idea, right? Especially when you got like risk sentiment really like weak at the moment, or starting to potentially get weak. Retail sales won't really change too much from a euro perspective. Now, I've got a couple of things actually. So let's start off with this one over here. A move above 110 remains possible beyond this week. So let's see why they say that. Euro dollar briefly printed above 110 yesterday on the back of huge Fed easing repricing. As mentioned above, the dollar may recover a bit more ground today, and we could see euro dollar slip back to the 109 mark. And let's just have a little look at that. We're at 109, literally basically at 109 now. The 2-year euro dollar rate differential is now negative 100 basis points after having touched 71 basis points yesterday. This is huge volatility, but also follows a tightening trend in the spread that started in April when it was at negative 160. Our short-term model indicates euro-dollar should be trading above 110, even if that spread re-widens by another 20 basis points in favor of the dollar. In the rest of the week, NOK should lead the pack in equity rebound after taking a hit yesterday due to low liquidity character. We would expect SEK to lag NOK due to lower beta to risk sentiment and speculation of a 50 basis points cut by the Risk Bank on the 20th of August. So let's just have a little look at that rates actually very quickly. I should have it on here. If not, I can just add it. It's not on here. So let's just look at the 2-year yield versus the US 2-year yield, and then on the daily time frame. reset the chart. Depends what are they looking at when they're looking at the rate. Swaps. Okay, this isn't swap rate. But what they're saying it from a swap rate perspective, it should actually be higher. Again, they're looking at swaps. Sometimes they look at yields. Swaps is obviously a different one. Swaps is this essentially. This is essentially future swaps. So yeah, they're looking at from that. What they're saying is even if it gets better in favor of the US by, let's say, 20 basis points, it would still be favorable for euro dollar to go higher. I'd say it's more so to do with markets rethinking. And even if that is the case, I don't think euro dollar will go above 110 if the markets start to rethink that risk sentiment gets slightly better again. I'd say that's more like a longer term view rather than a shorter term view, at least in my opinion. And based on what we've seen today, right? The price action today does definitely suggest that markets have kind of rethought the sort of risk sentiment idea. Euro dollar has pushed fairly aggressively to the downside on a sort of 4 hour, 1 hour perspective. So that does definitely seem like that is the case. And even if we break below this low here, the next sort of push will be towards sort of big old repricing. Let's say it comes into the middle of this or the high of this range here. So yeah, that's I can understand why they say that. It does make sense from a rates perspective or from a swaps, if you will. But I'm just following what the price action is telling me at the moment. Now that's ING. In regards to, let's have a little look at this one over here. Let's start off with this one over here, which is this one. Okay, so let me quickly share my screen, which is this one over here. Now, they took more about the dollar of this one. On the basis, my thinking is that growth across most regions is clearly slowing, but the height of the panic yesterday marks the extremes with a vacuum in terms of data now for a few weeks, and also Jackson Hole to come later in the month. Let me quickly just zoom in a little bit. I'll zoom in one more. I can. This one here, perfect. Now, not clear what turns things round, but we have gone from the US is slowing, cooling to recession fear and talk of emergency cuts in a week. Perhaps we are somewhere in between. First, Fed speak since last week's payrolls didn't match the panic price action, and ISM services did not extend recession concerns. On that basis, my thinking is that growth across most regions is clearly slowing, but the height of the panic yesterday marks the extremes with vacuums in terms of key data now for a few weeks and also Jackson Hole. So whilst the knee-jerk to the data last Friday was a sudden loss in confidence in US outperformance, and hence reacting by selling dollars from here, I think is less clear. The euro did what I was looking for and bought some pain above 110. Happy to let the majority of the longs go up there, given as most know I dislike the region on a longer term basis. It seems like someone just typed this out. Elsewhere in G10, still thinks places more stubborn in cutting. The euro performed well as an anti-dollar post payrolls, and clearly there was an element of deleveraging of euro funded positions from here, and having put a decent 48-hour move to above 110, things less clear to me. And as such, squared tactical longs, which worked well. Medium term still bearish overall, and question from here is what that, and was that enough? And do I need to think about re-entering shorts? Or is there still a bit more in these moves to come? I think they're talking about like a move above sort of that 110 level. Having inflicted some pain above the March highs and obviously through the 110 level, if we lose momentum and close below the 108.70 level, would be more confident in the top is in. So what they're saying is if euro dollar closes above, what was it? 10, sorry, just lost the page there. I'm just trying to see where they're talking about so I can just go on the chart. This is what you should be doing is why do they say 108.70? Then go on your euro dollar chart, mark up 108.70, see if it makes sense from a technical perspective. Now, key levels remain 107.90 and any further up moves to the December high of 111.40. So what they're saying here is, or this person, Beatrice, they're suggesting it looks like it's a lot more overstretched and overdone in terms of the big old dollar sell-off, which is obviously true. Again, like it is a large move to the downside. Euro dollar obviously did react a bit accordingly to that idea. And again, you got to think, does Does this mean euro dollar goes all the way back above 110? I mean, it's entirely possible. But what we'd need to see is a further deterioration in sort of that US outperformance, if you will, i.e., the US data go a little bit lower from here. And if that's the case, then yes, you would definitely see euro dollar go above 110 at that point. But for now, it is due a correction, if you will, at least like a pullback, what we've marked out anyway. So if I just quickly share my screen on that front, in terms of like that pullback opportunity, potentially for us, again, we'll just have to see how the data performs in the US. Like a 50% correction is basically back towards the lows pre sort of, what was it? Not pre, sorry, post 1 o'clock lows, which is this closure here. And then at least a 50% or 61% would be about the highs made here. And that would be where I would prefer to target, just because if we don't see any more issues in sort of the US front, the markets are going to go back to sort of where we were previously, right? Where it would be essentially just 50% of this entire move here. So as you can see, it's literally just 50% of this entire sell-off. So that the 61 on that move higher makes a bit more sense, to be honest with you. And rather than going all the way back below the lows, we'd only do that where we go sort of back towards these lows here, maybe even lower, is if the US data does suddenly start to get better and the markets actually think, instead of expecting 100, we now expect back to 50 to 75, which is basically where we were pre-Friday. But we was bubbling about 70 basis points pre-Friday. But now we're well above that. Let me double check where we're at the moment. We are at, for the Fed, 122 basis points. So the markets expect 125 basis points worth of rate cuts. That seems a little bit overstated, let's be honest, especially if the data starts to creep back up again. In that environment, euro dollar will go back towards 61, maybe even lower than that, and reprice all of that Friday's leg. That seems more of the likely option. And then we can monitor, does it get worse? Does it get better, etc.? And we could just react from there, from that perspective. But for the rest of the week, for euro, do we have anything to go off? Let's have a little look. It's actually a pretty quiet week for the euro. German factory orders did get better, especially from both perspectives there. Private payrolls got a little bit worse. 745. Markets didn't really react. We saw retail sales, as you can see here, get a bit on the negative side. Markets didn't really react much. And then for the rest of the week, tomorrow's pretty dead. Friday's pretty dead. So yeah, euro dollar is literally just going to follow, again, like similar to the pound, actually. What does risk sentiment do in the US? So focus a bit more on the US front this week and think to yourself, does it get better or does it get worse? If it gets better, then you're going to see probably risk sentiment come back into focus again. You'd see like equity markets get a little bit better. The euro is also going to react. So you might see like a euro Aussie push to the downside because, again, if sentiment gets better, AUD benefits from that environment, of course. So euro Aussie weakens off. So I've had deleted euro Aussie off my thing. I did. Let me add that back on it quickly. But yeah, euro AUD. So let me go back to technical. Let's go on to technicals. It's just not much else to talk about for euro for again, like just for this week anyway. But yeah, euro AUD will go back towards the downside, right? We've obviously pushed up logically because of, well, risk sentiment is obviously very negative for AUD at the moment. So obviously that makes complete sense. But if we do see a sort of a recovery, think how stretched this is to the upside from a technical perspective, at least over this leg here, right? Pretty stretched. So obviously that means if it does generally marginally get better, there's more downside risks at this point than upside. So what you then do is just look to your lows down here, right? And think, okay, euro AUD will likely push down towards these lows if risk sentiment gets a bit better. For example, that's kind of how I would interpret it. Euro CAD, similarly, to be honest with you, we saw really weak CAD, really weak dollar on Friday, of course, which is this one here. Of course, CAD does also weaken on that perspective. It weakens on the crosses in that environment. We've seen a little bit of strength in the dollar today. So EuroCAD is also pushing slightly on the lower side. So similarly, for a lot of pairs, what I'd say is, okay, 50% of the leg, 61, I'd say more so because it comes back into these highs up here. So it'd be like that, and then just sort of just do this. I think, okay, probably will come back into these highs first, monitor price action, and then we can react accordingly. If risk sentiment does get a little bit better, then we would likely break below that low, break below this zone, sorry. just come back towards the 71, 78, and then we can react from them, maybe actually even 50% or 51.5, which is this level here, just above 71 is what I would personally say at that point. Because again, just because you mark out a zone doesn't generally necessarily mean it's going to hold, right? You got to watch price action, watch the reason the pullback's happening. Is that continuing in terms of the reason? Like the pullback to the downside would be more so like the risk sentiment getting slightly better. Euro CAD will push it up a bit lower in that environment. So if it's getting better and better and better and better, then this zone is more likely going to get broken. So that's kind of how you would interpret that. Euro GBP, again, like we're at the top end of this level again. The question we have to ask ourselves is, can it go higher from here? Personally, I would say no, just because of, again, like if you remove risk sentiment, is the Fed is not the Fed, sorry, the BOE is a lot more hawkish than the ECB. The UK's data is better than Europe's. So realistically, it should be lower Euro GBP, right? It's just because of that sort of risk sentiment, if you will. Again, Friday, really weak. Pound, obviously, because equity markets slumped. We saw then, obviously, really weak pound again, because again, markets went were a little bit worried again also yesterday. And then obviously today, still also pushing. But nevertheless, I wouldn't say it's going to go back above these highs. There's no real reason for it to push back above these highs and target these next highs. Let's be honest. So yeah, I'd say this is more so the top end. So 86 seems like the range. And then the middle of the range would be about 8.5. Bottom of the range would be about 8.4. So you can see it. This is the top. This is the middle. This is the bottom of the range. So if we hit the top of the range, we'll pull back towards the middle. What happens in the middle depends on the data. Do we break below that? Okay, the bottom end of the range is going to be like that. That's kind of how you would interpret that. Euro yen, again, similar. It's just going to follow the sentiment. So euro yen is obviously, we should realistically push lower, especially if the BOJ and the data, we did actually, forgot to mention that, whilst we're looking at the euro yen anyway, is we saw, what was it, this morning, average cash earnings from Japan actually got really good. So again, that's fairly supportive for the BOJ to be a little bit more on the hawkish side still. That should reinforce lower yen or lower euro yen. So again, as long as we can get that pullback, we will definitely look to get in. Euro New Zealand, and that would be more so because of JPY fundamentals rather than risk sentiment getting worse. Risk sentiment getting worse will just absolutely push this even lower out of velocity. But even if risk sentiment gets better, you'd still want to be a bit more bearish euro yen, especially if like the BOJ is still pretty hawkish, right? Euro New Zealand, again, it's literally the same as Euro Aussie, right? Euro New Zealand, if that gets better, or its markets go slightly risk on again, i.e. equity markets rise back up, then you would likely see Euro New Zealand just pull back a little bit of the leg, and then maybe we can go back up again. We'll just have to monitor. We do have some New Zealand news this week, actually. So we'll just see on that front. And then lastly, Euro dollar, again, as we know, we'll look towards that sort of leg down here around the 61, and then we can monitor from that reaction. But we know it will break below the 61 and go lower and lower and lower and lower, is, as I've kind of spoke about earlier, is if the data in the US gets better and it battles the unemployment rate rise. Because obviously an unemployment rate rise is really bad for risk sentiment, right? Or really bad for any economy. If we see this as like a one-off, then the markets are going to go back sort of bullish the dollar at that point, at least until towards sort of election period. So yeah, that's just something for us to monitor there for sure. Now, apart from that, that is myself on the euro. Relatively quite weak for well, in terms of data, as I've just shown you, literally nothing. So for now, just follow euro's reaction to sort of risk sentiment. That's essentially how you should be trading this week. Obviously, look at the data anyway. But like the question you ask yourself is, does risk sentiment get better? Let's say unemployment claims goes towards the downside, which is obviously good for any economy. Obviously, you want less people claiming for unemployment, right? Or unemployment claims. So yeah, again, that's what I would be more focused on this Thursday's data within the US. And that will tell us is if risk sentiment will then generally get better again. But apart from that, there's myself in the euros. Let me stop sharing my screen to summarize. Again, for the euro, there's not data specific. This week is pretty dead. It's all one-star news. So just follow what the US is doing. If US gets better, you'll generally see a little bit of a sort of reaction in the euro. If it gets worse, the euro will benefit against like the AED, the New Zealand's. It will euro weaken off against the Japanese yen, of course, and it will weaken off against the Swissy. So just follow the US. That seems to me like the key theme, at least for the next week or two, until we get more US data. So that is myself on the euro. Let's move straight on to the AUD.
So the Aussie guys and girls. Now, Mark couldn't have said it better with regards to the euro. There's not much sort of moving on the euro side of things, but there is a lot moving on the Australian dollar side. So let's have a look. Now, we did get a hawkish hold early hours of this morning from the RBA, which I'm going to dive into and discuss with you all now shortly. Hence why we are seeing a bit of a reaction following that meeting, but nothing too crazy, okay? Now, equally, why is it important that this is a hawkish hold? It still gives us the idea and the understanding that RBA will be a late party central bank that are cutting rates so far from what we know. Now, also there are other external and internal things to be aware of with regards to the Australian dollar this week. Firstly, balance of trade is a very important print for Australian dollar from China on Wednesday. If China are producing and exporting more, likely they are going to recoup a lot of the capital to reinvest back into their economy via Australia's materials. So it's a very positive Australian dollar effect when we see balance of trade up in China, or just in general, Chinese health doing well with an economy. So that's why inflation, of course, on Friday as well is very important for Australia, because again, if people are spending in China, if businesses are growing, if the economy is let's just say expanding, or prices are inflating, it will play into the narrative that money will circle to Australia off the back of that. And of course, we know, like Mark said, the weaker dollar will, of course, tend to pick up that Australian dollar, but of course, it's subject to the environment that we're in, basically dictates that sort of flow of money. I mean, your dollar could weaken off due to recessionary fears, global hard landing fears. Aussie's not going to perform well in that environment. And also on the Thursday, we have business confidence. Keep track of this for Australia, of course, for obvious reasons. More confident businesses, the more they're going to produce, the more they're going to expand. Now, let's break down really, because when it gets to Friday, I'm going to have a lot to discuss with you guys and girls in regards to the Australian dollar. Of course, we've got all of this to discuss. But let's break down what's happened this week so far, which is essentially the interest rate decision. Now, the Reserve Bank of Australia leaves rates unchanged but keeps a hawkish tone. There is a disconnect between the Reserve Bank of Australia, Governor Michelle Bullock's assessment of inflation risks and the market's continued optimism for rate cuts by the year end. So this would not have been a sensible time to hike. Last month, we took a chance and forecasted a rate hike for this meeting. As of yesterday, that forecast lay in tatters. We had still been prepared to take a gamble with that call following 2024 and June CPI data. But even though they showed a slightly better outcome for core inflation than expected, the forecast was already looking highly speculative. Now, an additional nail in the coffin for the rate hike view, and maybe more of a stake through its heart than a nail, was the market turmoil that has followed basically on that NFP print. So they're referring to here that not only did we get, or we didn't get, Australian dollar strength from a hike that didn't happen, but they're saying, in fact, the Australian dollar has been heavily unwound from a carry and heavily scrutinized due to the beta risk sensitivity that it has to global growth. No sensible central bank would have been hiking rates against that backdrop, and we are not surprised or disappointed that the RBA left its cash rate unchanged. So the inflation story is not over, and this was the exact paragraph that the market picked up on. Inflation in underlying terms remains too high. And the latest projections show that it will be some time yet before inflation is sustainably in our target range, or in the target range. Data have reinforced the need to remain vigilant to upside risks to inflation, and the board is not ruling anything in or out. So they're leaving the door open, basically. Policy will need to be sufficiently restrictive until the board is confident that inflation is moving sustainably towards the target range. In other words, that's a hawkish hold. Okay. Now, the market still sees cuts by year end. Given this, it's perhaps a little surprising that the market is still looking for rate cuts by year end. But I think the reason the market is looking for the rate cuts, and we may get them, is just because of how aggressive the rhetoric has turned recently in central bank sort of realm, from the Fed to RBNZ and so on and so forth, or the pricing at least. So on the back of that, I think the market is now pricing more of an aggression on the RBA. Now, cash rate futures have priced in about 90% chance of a 25-bit cut at the 10th of DEC meeting. That may still be a hangover from the market turmoil over the last few days, and we expect further retracements of the excessive panic that gripped the markets Monday when cash were close to price. Okay, perfect. So in our view, even a solitary December cut looks too much too soon, and our revised forecast for cash rates, which will trim down to 4.35, our peak cash rate forecast will not consider rate cuts until 2025. So RBA, I think, is still going to be one of the last central banks to cut rates, and I still think they're the perfect candidate to express any global soft landing optimism through on a weaker dollar front. And this would be, in my opinion, best expressed through something like EA downside, GA downside, or Aussie Swissy upside. Not financial advice, of course. Now, RBA pushes back against near-term rate cut on inflation risks, and basically this is just summarizing it all again. That snippet the market took from the speech, and a largely hawkish hold from the RBA, head of APAC macro strategy at State Street Global Markets. Some of the optimism born of weaker Q2 inflation has been largely discarded in favor of commentary that continues to see underlying inflation too high. Ultimately, it was very hawkish hold, and that's the bottom line. Bloomberg economists say that while the central bank's tough rhetoric suggests little appetite for cuts in the coming months, the detailed outlook suggests a path to potential easing in the fourth quarter remains open, which, that's the question on everybody's mind, right? So there wasn't too much volatility off the back of it. We knew we were going to get a hold. And now it's just about really playing your cards right. I mean, the Aussie bounced spot 89 with ACAD. Of course, Aussie sold off against everything. It's the most risk-sensitive currency when it comes to sort of global growth fears and whatnot. And the bounce of 89, you could argue 88.5, but I put that there because that's where price sort of settled. What I'm intrigued now to see is this sort of range. I did update these charts yesterday, but I don't know why they've not saved. But yes, so this is what I'm more so concerned about, is this in the immediate term. Do we break above 90.5 and trade higher, or do we hold above 89? And will this be our new range? If you're a range trader or looking to hedge this position, that's the sort of approach I would be taking. Now, Aussie Swissy hitting the floor, everything Swissy's hitting the floor, We're now pressing COVID lows. I think we'll start to see some consolidation on that break. Aussie Yen, I'm just stepping off. I have no appetite to be in this whatsoever. Aussie New Zealand, however, is offering great value, and the market snapped up that 108.5 handle, as you can see. So, it would not surprise me to start seeing 109 fill. And now I think maybe if we're contained at 110, we have range-bound price action until we get further catalyst for upside or further risk sentiment settling. And AU, I think we're going to be caught between the spot 63 and the spot 66 handle for a while now, subject to dollar fluctuations. I have no desire to trade this at the minute. The price action is absolutely vile. But on the sort of face of it, commodity-wise, copper is down, still trading now below that 4.1 mark. Iron ore is just tracking sideways, but at those April lows. Nat gas is again bouncing that 2 mark that we've spoken a lot about. And the ASX is basically, as is every other, it's down heavy. But the ASX, like I said, it's more reflective of a sentiment and optimistic / pessimistic outlook, as opposed to something like the FTSE, for example, just because of how sensitive it is and how reliant it is on certain exports and business being done based on global growth. The only one that I'm really sort of liking at the minute is the range with Aussie New Zealand and the range with Aussie CAD to potentially hedge your way out of a really good position there, especially if we get some bad CAD data, and we see some settlement on sentiment, and we see maybe a lot of the moves recovered. You may get something like this by Friday, would not surprise me whatsoever. So on the Australian dollar, guys and girls, be vigilant of the external drivers this week. China, balance of trade, internal drivers being the business confidence, so on and so forth for Australia. It was a hawkish hold at the end of the day. They're very unlikely to cut this year. Even if they do, it's only going to be one, in my opinion, so far from what we know from the data. Hawkish rhetoric, they still have the interest rate differential lead. And as they keep rates on hold and other G10 banks start lowering rates, so long as sentiment is tame, I think Aussie will really pick up in speed and have that advantage. So that is us, guys and girls, on the Australian dollar. Let's jump into the Canadian dollar.
So the Canadian dollar. Now, as you know, really not that much has happened since Friday in terms of CAD news, like CAD-specific economic news. This week, in terms of economic news, if I just quickly show my screen, we do have a little bit, but more towards like the latter end of this week. So if I just quickly filter that, and then I will share my screen here. But yeah, we have some data at the latter end of this week. We might see a bit of movement tomorrow from that, but I very much doubt it. We just haven't seen much movement from that recently anyway. So it's more so going to be this Friday's employment data. Now, as you can see, employment change, 26.9K is the forecast. Obviously, higher the number, the better. But for us, I mean, this is very, very choppy recently. So if I just quickly show you that, at least since the start of the year, you can see it's been up, down, up, down, up, down. On the most part, a bit on the upside since 2024 anyway. But the moment we've seen upside moves, it's always come down very aggressively. So we're likely to see a little bit of a rebound. But the question you ask yourself is this out the norm? Is this a significant amount of economic strength? No, not really, because you can see the overall trend has been basically between 25 and 40-ish K. So yeah, that wouldn't really move the needle much for the Bank of Canada. This may move the needle for the Bank of Canada. Markets do expect a little bit of a rise in the unemployment rate to 6.4%. Let me just double check where we're at in terms of the trend. We are starting to trend a bit on the upside now, as you can see, since 2024, just up. That won't generally be a good sign. That should just reinforce a bit more on the rate cutting cycle. Or it should tell the BOC actually that we should be expecting a bit more rate cuts going forward. Now, obviously, as you know, the elephant in the room is the Fed and sort of what that data is doing. So on that front, let me just where we're at in terms of the Bank of Canada, markets expect 130 basis points for the entire year, right? That's not from now until the end of the year. That's what we've had. So we've obviously had 50 basis points of cuts this year at the moment, last month and this month. So that's 50 out of the equation. So markets basically expect, a lot more. So we have to ask ourselves, does this seem appropriate at the moment? Maybe. That's basically a cut every meeting from now until the end of the year. That does definitely seem feasible, especially if the data continues to point in that direction. Now, obviously, we've got the risk sentiment at the moment. Now, if we see a little bit of a recovery in risk sentiment, like markets expect, actually, maybe the US is not going to go into a recession, i.e. the data gets a little bit better in the US, we more likely see a little bit of a recovery in the CAD at this given stage here. So EuroCAD will push towards around, as we mentioned, for the euro, this zone between 50% of 61 or maybe towards that 1.50 level on the chart. You'd also see like euro, Aussie dollar CAD as well. If risk sentiment does get better, I'd actually expect more so Aussie dollar to benefit out the equation. So far, we haven't really seen any breaker structures. Again, that lower high hasn't broken. That one has been broken. That one hasn't. That one hasn't. That one hasn't. So you can see the downtrend is still technically intact. However, we do want to be bullish Aussie dollar CAD this year. It's just a matter of being patient and waiting and seeing does it make sense for the break? If it does, perfect. We get in on the pullback and then we can get long again. So that's what I'm more so viewing CAD. Now, I've got one thing from JP Morgan. A bit squeeze higher in dollar CAD as London walked in yesterday, but the pair spent the rest of the session trending below or lower to finally close to the 138.4 to 138.60 level. Price action in FX continues to be dictated by dollar yen, which has rebounded sharply post better than expected ISM services. Flows were very tight in CAD, with our client base focusing mostly on JPY, but also the euro, which briefly broke above the 110. Equity seems to be rebounding today, with Japanese stocks leading gains, which should see risk trade slightly better. Still not sure where to position myself from here. On one side, recession risk alongside poor August seasonality, having me wanting to be long of dollar versus high beta. So what this person in particular is saying is it's a bit tricky to trade the environment at the moment when you've got risk sentiment saying one thing and seasonality saying the one, also potentially like recession stuff, right? So it's going to be a difficult next couple of weeks in the markets to trade. So just trade the most obvious plays out there, the ones that make the most sense, rather than just choosing trades just for the sake of it. Again, don't be surprised if you trade like one or two hairs for the rest of this month anyway. Now, we got PMIs out of Canada this afternoon, but focus on the BOC's release of summary of deliberations as well as employment on Friday. So this person in particular, Beatrice, suggesting it's a little bit difficult to trade at this moment. Maybe even the CAD as well. It's very light. What they're saying is very light flows with CAD. And again, people are more looking. So, what are the best plays out there? Obviously, these people here, JPY, and obviously these people here, which is the dollar. That seems like the better plays at the moment rather than just trading the CAD. So, if you're going to trade the CAD, maybe trade it more shorter term rather than longer term at this given stage, just given what's happening in the market at the moment, of course. So like a EuroCAD tactical sell, for example, or a GCAD tactical sell to eventually go back up again on the longer term perspective. So that's what I would be more so for CAD. So yeah, that's really all I got. We'll talk about more of the employment on Friday. But for now, that is myself on the CAD. So in terms of technicals, have I got much? Not really. CAD Swissy, we're reacting from this sort of 62 level. But overall, it's not really opportunity for me. I'd rather a little bit like risk sentiment gets slightly better. And then eventually fundamentals continue to take place where CAD is actually pretty bad. And then obviously CAD yen, similarly for everybody else, risk sentiment gets a little bit better. CAD recovers a little bit against the yen. And then obviously this will be driven by obviously CAD fundamentals being weak and JPY fundamentals being strong. It's meant to be an arrow, but being strong. And obviously in that environment, you'd want to be obviously selling CAD JPY to the downside. And then lastly, obviously we've covered all these pairs already, AED CAD as well. I like a little bit of a breakout of that level. The issue for us is obviously that risk sentiment is weighing on Aussie dollar, obviously. So again, we don't really want to be battling that until we see it get better. Because if you take risk sentiment out of the equation and sort of external factors, it's the data you should realistically be much higher in the CAD. It's just a pullback. A pullback was necessary. Markets just used the risk sentiment as the reason to pull that back. But overall, that is myself on the Canadian dollar. To summarize, again, there's not that much data until about Friday. So on Friday's breakdown, we'll speak about more on what that data. But overall, we have to ask ourselves is sort of what's driving the CAD at the moment? Obviously, it's sort of it's weak CAD data and also dovish Bank of Canada, but also risk sentiment. And obviously, risk sentiment is very up there. It's sort of at the top of everyone's list at the moment. And if risk sentiment is really poor, especially in the US, the CAD also does weaken a lot anyway. So obviously that will go with our view of being bearish CAD as we have been for the past few months now. But if risk sentiment does get better, you will see a little bit of a recovery in the CAD, but not by much, because then at that point, the markets will kind of go back to where we were pre-Friday. And at that point, people were still very bearish to CAD anyway. So if you do see the CAD strengthen, which we are seeing at the moment, like GCAD and EuroCAD pushing lower, obviously it's understandable why that's happening given the sentiment. But at some point, those pairs should be higher. So what we need to be focused on is like the consolidation at specific zones, maybe breakouts of zones. And then that's when we're going to go back in, as long as sort of we see that sort of sentiment go back to normalization. If it doesn't and it gets significantly worse, then obviously that's another story. But we'll cross that hurdle if it comes. But for now, that's us on the CAD. Let's move straight on to the New Zealand dollar.
So guys and girls, the New Zealand dollar. Now, I'm going to keep this one real brief because next week when we catch up, there's going to actually be something to speak about. But what I will say, not next week, Friday when we catch up, sorry. But what I will say is we do have the unemployment rate coming out later on tonight, which may trigger some further pricing of cuts coming for the RBNZ, similar to what we saw in the US. But there's a lot already baked into price with New Zealand. But next Wednesday, we do have the interest rate decision, and the market is expecting a cut, which brings us on to this. Now, investors bet on RBNZ rate cut next week amid global repricing. So the New Zealand dollar is getting priced lower and lower and weaker and weaker and weaker. And it would not surprise me to see the New Zealand dollar basically remain on the back foot moving forward, guys and girls. So investors and some economists now expect New Zealand Central Bank to start cutting interest rates next week as markets globally ramp up bets on imminent monetary policy easing. They will cut rates by 25 basis points to 5.25 in its August. This is what if they do cut, and deliver further reductions to 4.75 by year end, the Bank of New Zealand stated. The economy is buckling, inflation is controlled, given the lags between rate moves and their impact on the economy, which is usually 6 to 12 months. The current parlor state of New Zealand, we strongly advocate the bank starts a progressive easing cycle from the August meeting. So the point I'm getting at here is the central bank are aware that globally, look at the reactions you're seeing and look at how data is starting to buckle. They are already in a buckled situation. So the higher they keep these rates here, the more the economy is going to suffer. Do you know what I think? If we do get a rate cut from the RBNZ, it would not surprise me to see a 50 bip cut from the RBNZ, which would, looking at something like Aussie NZD, it would make a lot of sense hedging this going into that meeting. I think hedging around the New Zealand going into that meeting, yes, there's going to be a lot of volatility, but it would make a lot of sense. Now, such a move will be swift reversal of the stance of the RBNZ, which it may consider raising rates. So you can just see the volatility that is basically sitting on the RBNZ shoulders at the minute. And they do have a credibility issue, basically. We're not convinced the RBNZ will pull the trigger next week. They should, but it's still unlikely. There's a credibility issue for the RBNZ's forecasting team. The central bank is supposed to take into consideration the minimization of volatility and output of interest rates when setting policy. To delay cutting much longer risks maximizing volatility. So that's basically, the New Zealand dollar. We'll have some employment data tonight, so we'll cover that on Friday, and we'll prep then for the rate decision next week. But ultimately, the New Zealand dollar is it's on the back foot. It's paying, it's Spain without the S, really. It's gotten the value to even price in. So what we're seeing is, at the minute, it's 82.750 or 82.75, and 81.25 is our range on NZD CAD. Do as you wish with that. I will not be trading it. NZD Swissy and NZD Yen, we know the volatility that's been presented there. We know the safe haven flows, XYZ, and the New Zealand being a risk-savvy currency. So I'm not really looking to entertain any positions NZD JPY, NZD Swissy. The unwind of that carry can really continue. NZD USD I am, though. I'd like to hedge my way into something on this. Now we're bouncing 58.5. We took out the low. And we do have on the lower time frame, I think it's 6 hour. Nope, it's going to be 4. We do have somewhat of a level on the spot 60 handle. That being said, this is definitely a bit of a ceiling, isn't it? For this pair, 59.75. So maybe watch how that 59.5 handle trades and maybe go from there. But for me, I mean, how am I trading this price action? It's not clean whatsoever. And it's something that we just have to basically sit and let develop. So for me, there's nothing really on the table with regards to NZD. It's more of a situation of how do we move forward with the NZD. I would like to express any potential risk on plays really via ADNZD, taking New Zealand as a weaker counterpart, and any stabilization in the US or any overpricing of rates in the US or any Trump pricing, so on and so forth. I think NZD USD is really vulnerable. But from my point of view, there's not really a reason to be anywhere near optimistic this New Zealand dollar. And that's my summary on today's New Zealand dollar. So yeah, apart from that, let's jump straight into the yen and the Swissy.
So the yen and the Swissy. Now, as you know, obviously, if you look pre-Friday anyway, the yen was kind of strong. For obvious reasons, the BOJ was pretty hawkish. Their data started to get better. And obviously, we saw sort of an unwind, if you will, of those carry trades. We saw even more yen strength on Friday and obviously yesterday because of the fact that, well, in a risk-off environment, especially when it's US specific, the yen does tend to strengthen by a lot, especially as well if you couple that with the sort of lower yields that we saw on sort of Friday and yesterday, where the 2-year yields and the 10-year yields were all falling. In that environment, that's another bullish sort of reason to sort of be long JPY. So there's a lot of factors going for it at the moment. I do feel though, like I can agree, like it is pretty overstretched to the downside. So we do need a pullback before we eventually get back in again. So let's just have a little look. Now, if we firstly look at this one over here, which is just JP Morgan's view on the carry trade idea and perspective, they say that there is more to come. And they're saying it's only about halfway done. Now, we aren't done by any stretch, says Global FX Strategy co-head. The moves come amid fears of US recession, Japan rate hike. Now, the recent unwinding in carry trades has more room to run as the yen remains one of the most undervalued currencies, according to JP Morgan Chase, which is true. They're talking about undervalued on like model perspective. So if you look at it from like there's the specific models like, what was that model called? PEP, I think is what it's called. Like REAR, which is a sort of it prices in the exchange rate. even from like a chart perspective as well, like go on dollar yen and onto the daily time frame, it is very, 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 very high. So there's a lot of metrics that are still it's stretched. I'm just talking about short-term positioning. It's quite stretched. But we aren't done by any stretch, says Arindam. The carry trade unwind, at least within the speculative investing community, is somewhere between 50 and 60% completed. The trade has been pummeled this week as yen volatility jumped amid fears of looming US recession and after the Bank of Japan's first rate hike, rate hike. Yen carry trades borrowing from low rates in Japan to fund purchases of high-yielding assets elsewhere have long been popular among investors as volatility remained low and traders bet Japanese interest rates remain at rock bottom. But an 11% appreciation in the yen against the dollar over the past month has turned many of those trades into money losers. The subsequent rush to close out yen positions have jolted both emerging and developed markets that used to be destinations for investors to deploying a strategy of higher returns. A good case outcome is stabilization of the market around current levels, maybe a shallow retracement at best, but in many of these instances, you tend to get continuation of moves, if at a low velocity than what you had seen before. Obviously, yes, when there's a giant amount of volatility that came in. Is that likely to going to continue? Probably not. Just because you get a lot of things that happen very quickly, all in the space of about a week and a bit. So like really hawkish Bank of Japan. We saw sort of the carry trade unwinding. I believe literally like a week before that, we saw MOF intervention, even though data in the US is weak. So there was a lot of things going for it. Now, the yen carry trade appears to be unwinding at the fastest pace since the currency surge in 2007. We've been alert to the risk of a sharp reversal in the currency's fortunes since March, and is now materializing. Our models show that the fear of the US slowdown is the main driver, not so much the recent rate hikes by the Bank of Japan. The yen's moves from here probably depend on how the US economy evolves and how policymakers at the Fed react, which is obviously true. So that's essentially what we need to focus on for the yen anyway going forward, is how does the Fed or the US's data present itself? If it gets slightly better, then you are going to see a bit of weakness in the JPY. We're not going to say it's going to go all the way back above the highs, but you're going to see a pullback basically. And that's basically what we would like to have, is just a pullback to then eventually go back bearish again. Because hopefully by that point, the Fed will start to be cutting and more and more dovish. So that's my sort of perspective. Obviously, we need to focus on the elections, but for now, that's not really at focus for anybody. It's more so the US's data. So that's essentially what we need to focus on. If we just look at this very quickly. So if I quickly get up this, I think we are still overvalued. We are, but we've closed that gap very, very quickly. But you can see at least over the couple of, where's that vertical line? This one here. At least since here, rates have kind of been the main driver of yen, although it's not followed it like it had done obviously in 23 and 22, because obviously we saw a massive dislocation here where dollar yen was pushing higher. Obviously, this is an environment where rates isn't the main driver. But now we saw that reconnection around and 24th, 25th of July, where rates have pushed lower in the spread, and JPY has also strengthened against the dollar. So it seems like rates are also another big driver. And what would rates be driven by? Obviously, it's US data. So what do we think about? Okay, if rates is one of the main drivers of the US, what drives rates? Well, it's data. So what do I need to do? Focus on the data within US. And that tells you how much more downside dollar yen goes or has. It should technically be about 133.5, 134 if it was following rates correctly. But you can see it's really closed the gap very, very aggressively, which does suggest it has more room to run. I would just like a little bit of a pullback, at least in the near term. And then we can eventually get back in again. Now, Nomura has stated this about dollar yen. Let's have a little look. They had a really good chart as well of just drivers of the dollar, or what currencies move with the dollar. Now, we are lowering our near-term forecast. Risk of dollar yen dropping below 140 in the immediate future, / focusing on whether the Fed will cut rates substantially, / will Japanese investors accelerate JPY appreciation. We think it's too early to say whether the US economy has embarked on a downturn, which is true. It is technically one bit of data. We think there could be renewed upward pressure on the USD in October to December, reflecting a possibility of Donald Trump winning this year. For now, therefore, we maintain our end of December dollar yen forecast of 148. Risk of JPY appreciation is if shares do not rise around the time the Fed begins cutting rates, we see a risk that the market speculation could cause US rates to fall further and JPY to strengthen further against the dollar. Moreover, we think JPY could continue to strengthen for longer if Japanese investors accelerate their covering of short JPY positions, which they use short JPY positions to hedge mainly. Now, and then where are we? Based on our view that the Fed will start cutting rates in September, we had expected USD to stop strengthening in July to September. We had thought that dollar yen would probably undergo a temporary correction through the summer, partly reflecting the possibility of an increasing hawkishness on the part of the BOJ. But recent developments have been a lot quicker than we envisioned. We have lowered our September or end of September dollar yen forecast from 150 to 143. Moreover, while we expect dollar performance to move in response to US economic data in the near term, we cannot rule out the risk of further correction below 140, which is also true. And obviously, this is their forecast. So let me just quickly screenshot that, put it in the Discord for us. But yeah, that's their view. What they're saying is, again, like they are kind of also in the camp where as we get towards election, maybe the dollar strengthens. Obviously, depends if, like they mentioned there, is if the Trump markets, price in the possibility of a Trump winning. But for now, it's more so what the data does. So if the US data continues to show weakness, obviously yesterday's PMI has battled that idea anyway. But if it does continue to point to weakness, then yes, you definitely want to be more short dollar yen or just long JPY in general. And obviously you compare that, or you take the yen and the sort of buy it against almost pretty much everybody. It seems like JPY is overvalued against pretty much everybody. And this is just some of their forecasts here. So they expect about a 143 and then eventually ending the year at 148. Like what we just mentioned anyway there, they're viewing it more so through maybe markets go long sort of the Trump winning, and that would generally mean dollar strengthens anyway and dollar yen pushes higher. But 148 is not that far away if you think about it. We're at 144 too. So we do definitely have a bit more to give in the JPY as long as the US data turns lower. But euro dollar, they're expecting about 107 end to the year, and euro yen 153 and then 158 to end the year. And then eventually you can see they do expect yen to strengthen at least throughout the next year, hopefully. And obviously euro dollar to also eventually push back up again. And then this is the chart I wanted to show you, which is, if I'm just going to zoom in a little bit. So this is just the sensitivity of major currencies versus the dollar to global share prices and interest rate differentials over the past 52 weeks. Now, currency appreciation during rise in home country interest rates, currency strengthens when US interest rates fall. Substantial benefits from preemptive rate cuts in the US. And you can see AUD is basically the highest sensitivity to any shifts in that expectation. So you can see if the markets begin to expect more and more and more and more sort of, markets or the Fed to cut, and we see a currency appreciation during share price uptrends, so shares being equities, obviously AED is very sensitive to equities, then obviously you want to be more bullish than AED. Equities have fallen rapidly. USD or markets have brought forward rate cuts for the US anyway. However, the context is the important part. Why have they done that? Well, because of recession fears. Well, in that environment, during sort of recession fears and equity markets are getting pummeled, obviously the AED will not strengthen in that environment. If it's because US data is turning lower, it's like normalizing, it's not getting significantly worse, and sort of recession fears aren't really there, then yeah, the AED does benefit. But for now, that's the most sensitive. JPY, though, you can see it has the most sensitivity to interest rate differentials in terms of percentages and substantial benefits from major US rate cuts in the US. So again, and that's more so, as we know, JPY is very sensitive to US rates anyway. So that is obviously very, very logical. So how do we view that is what will move this lower, or markets expect rates to move lower? It's obviously going to be more weaker data. Hence why we're saying if you want to be more bearish or bearish dollar yen or bullish JPY, you need to see this increase the amount of rate cuts, or at least the dovishness increase. And that will generally come from more weaker data. If we see that reprice, like what we mentioned in the dollar, which is a possibility, then yes, rate cuts in the US is definitely a very, very bullish factor for JPY. But yeah, for now, I don't think JP Morgan said too much. That said, hawkish BOJ should continue to support the yen in the medium term. So biased to sell the pair on the rallies, which is true. They were pretty hawkish. But overall, I think that is myself on the JPY. But yeah, for now, with the JPY, just follow what rate to do it in the US. Does the US data weaken? If it does, be more bullish to the yen. If it doesn't, get slightly better. Think of it as like a pullback in the short term to then like the medium and long term to go back bullish to JPY. So yeah, that's myself on the yen and then the Swissy.
Perfect. So Swiss is very brief. We know it's catching a tailwind of the appreciation of the yen, and the uncertainty in markets is causing a lot of liquidation and a lot of safe haven flow, i.e. Swissy. Why is Swissy safe haven? Geneva Convention, political neutrality, gold reserves, financial secrecy. There's so many reasons. I could sit here all day. But what I will say is we have had a bit of data internally, but it doesn't really change the narrative much. Unemployment rate basically remained the same. Retail sales massively dropped off. But again, the market's not going to go, oh, let's not buy Swiss franc because people aren't spending or whatnot. It's factors beyond fundamentals at the minute. Risk sentiment always dominates fundamentals, of which we know that. But apart from that, the only thing that we have following on is consumer confidence on the Friday, which again is not going to move the needle. There's one interesting article here that I just want everybody to read, which says Swiss franc hits highest versus euro since 2015 amid volatile markets. Now, the Swiss franc rose to its highest level against the euro in nearly a decade on Monday as heavy losses in stock markets, concerns over US and global growth, and tensions in the Middle East invested safe haven currencies. Franc is up 3.5% against the euro since the Fed held rates. Early on Monday, the franc was as high as 108.5, so they priced the other way. Now, a spokesman for the S&B declined to comment on the franc's strength. So we have to remember the S&B may intervene and weaken their own currency if their own currency strengthens too fast and can basically cause numerous domestic problems for them. Now, he declined to comment on whether the franc's strength could lead to intervention. Now, the S&B has cut interest rates twice this year amid concerns among Swiss manufacturers that the strength of the currency was putting pressure on their key exports. Well, look at the strength of it right now. So will they intervene now to weaken their own currency and pull euro dollar higher, so on and so forth, to stable the output of their economy? Let's see. UBS economist Maxime Botterin said at the time the S&B is cutting rates, the franc's appreciation over the last 2 days could prompt foreign currency purchases by the bank. Another thing that it may prompt is the S&B to hold rates instead of cutting, which the market is priced for a cut. However, if policymakers are seriously concerned about the currency strength, the bank still had scope to cut its benchmark to below 1.25. Foreign currency purchases are therefore likely to be limited. So it's just something that I wanted to know. But really speaking about really quite weak domestically on the Swiss franc. If I just stop sharing my screen, it is more of a risk sentiment narrative with the Swiss franc. And I think summarizing both on behalf of the yen and the Swiss franc, Mark, in one hit, if you don't mind, I'll sort of mold them here with it's solely sentiment that's driving it. It started off with Bank of Japan intervention. It started off with this, started off with that. Now it's sentiment. It's unwinding of carry trades. Why are we unwinding? Because of global growth fears. Why do we have global growth fears? Because of recession fears, so on and so forth. So these currencies are just going to appreciate as things get worse, and they're going to be that flow of haven. Or if things look up a bit and things start to calm down, they're unwinding and they'll start to weaken as money moves into more optimistic plays. So that is us on the yen and Swiss, guys and girls. Let's jump into gold. So gold, guys and girls, let me just share my screen and jump in. Now, gold and silver, why is it that they didn't instantaneously appreciate during this uncertainty? Well, here's what happens. You have fund manager, bank, institution, whatever here, okay? You have the AUM here, and then you have what they're buying and selling. So let's just say they own gold positions prior to all of this kicking off, which there was a lot of gold positions being bought up, sub 2,380, right? And then, and this is the institution, okay? And then a big risk event happens, right? Such as a big missing unemployment rate, some rule triggered, so on and so forth. Everyone goes crazy. Not only did they dump their gold positions, just like they did back in COVID, they dumped their positions before they bought it. They dump everything. They dump equities, they dump commodities, they dump FX, everything. and the institution goes back to cash. Then what the institution will do is soak up at cheaper rates once they want to reallocate, reshuffle their portfolio and allocate into safer havens. So that's why I said I think the leg will be very much short-lived on gold downside, which brings me on to the analysis. So for me, I'm looking for a liquidation of anything sub 2,350. I think one more risk event to take this down, and I think we're going to see a very aggressive leg higher moving into this quarter. If this level does not get taken, I'd be inclined to believe that 2,400 is going to play a massive role. But let's see. But I'm more so only going to be entertaining positions sub this level that's been built. Silver's playing out of the weekly at the minute. It's respecting this 27 handle. Let's see how this develops. To me, I think this is super cheap. My target's 35 for silver. It's fine to go to a 6-month. My target is up in 35s for silver, which is up and around here. And I think it has the legs comfortably to get there. It's just a matter of having the catalyst to push it. Now, lots of analysts are calling for 40 as well, which is basically that monthly area of supply, like 2011 supply, but it's just where we last knew value to be. But I think we can, at a very minimum, I think we can run these highs. So yeah, I'm watching for silver. For those of you that like the sort of lower time frame, you can wait for a break of structure, pull back, whatever it may be. But yeah, I think this is ultimately very cheap. I think if this plays out of the weekly and you're looking to hedge this, 28.5 looks like a great hedge as well, not financial advice. But guys and girls, that is us for today's breakdown. Thank you for tuning in. We'll have a tiny bit more to cover on Friday, a bit more updates here and there, but relatively quiet week on the data front. It's more so risk driving all flow. So that has been your Tuesday, the 6th of August breakdown. Have a great trading week, and we'll see you Friday.
Take care.